Well, good morning, everyone, and welcome to GRI's first webinar of the year. And I'm very pleased to welcome all of you. I'm Vanda Vicars. I'm the Chief Operating Officer here at GRI, and I'm really delighted to welcome you to today's webinar, After Higher for Longer, Outlook for Bank of Canada, Rates and Inflation, with Chris Ragan and Warren Lovely. Although this event is virtual and many of you are joining us from across Canada and beyond, I wanted to take a moment to acknowledge that the Global Risk Institute is situated on the traditional territory of many nations, is covered by Treaty 13 with the Mississaugas of the Credit, and now is home to many diverse First Nations, Inuit, and Métis people. Through this land acknowledgement, we wish to bring context to the history of our country and the importance of working towards reconciliations in all the ways we can. Before we begin today, I'd like to review a few housekeeping details. Please note that this session is being recorded and will be shared on our website. Your microphones as participants, and I see that we've got over 100 participants that are just joining in now, have been muted to avoid background noise, and we've allocated ample time at the end for questions during the Q&A period at the end of the event. Please submit your questions through the chat, which is the bubble at the bottom right-hand corner of the screen, and we'll address as many as time allows at the end of the session. And finally, when you exit the webinar, you'll see a prompt for our event survey. Please take a few moments to fill it out. Your feedback is very important to us and helps us continue improving our programming. And now I'd like to introduce our moderator for today's session, Jason Stewart, who's an executive in residence here at the Global Risk Institute. Jason, over to you.
Thanks, Vanda, and good morning. Today's session is the first in GRI's 2024 Macroeconomic webinar series. This series aims to help our members understand macroeconomic policy's outlook this year, its impacts and risks. Our webinar follows 2 years where policy rates rose much higher and stayed at elevated levels for much longer than the markets and economics consensus expected. In assessing the prospects for 2024, our speakers will offer their perspective on the outlook for Bank of Canada rates, inflation, and financial market impacts. We are delighted that Chris Ragan and Warren Lovely are back for their 4th annual GRI webinar examining the outlook for Canadian monetary policy. We will begin our session today with remarks from Chris, followed by Warren. We will then move to the Q&A component with Chris and Warren, which I will moderate. I'm very pleased now to briefly introduce our distinguished presenters. Chris Ragan is the founding director of McGill University's Max Bell School of Public Policy and an associate professor in McGill's Department of Economics. Chris's outstanding career is well summarized in his webinar bio, including his distinguished roles with the Bank of Canada, Department of Finance, ECHO Fiscal Commission, and the C.D. Howe Institute. Warren Lovely is a managing director with National Bank of Canada Financial Markets, serving as chief rates and public sector strategist within NBF's highly regarded economics and strategy group. Warren is a leading fixed income economist with a long track record of incisive articles on monetary policy and its impacts on fixed income markets. I will now turn the webinar over first to Chris and then to Warren for their presentations and remarks. Chris, please begin.
Thank you very much, Jason. It's nice to be back and nice to be back on the stage with Warren. If it's January, it must be time to talk about monetary policy. So here we are. All right, so here is what I plan to say in my 10 or 11 minutes. I would just want to talk a little bit about the past, because it has been a remarkable few years. And then, of course, the question of the day, which is when will rate cuts begin? And the third thing is really where will rate cuts go to? So that's the target. That's a discussion really about the neutral rate. So I think it's worth remembering how unusual the last few years have been. So I've tried to summarize this in 4 points, and each one is sort of a 2-point point. The first thing is that we had a massive negative aggregate supply shock, which was intentional in the sense that it was about intentionally closing down big sections of the economy because people could not work in close proximity to others. And that had associated with it, what I say, a linked negative aggregate demand shock. People like most of the people probably on this webinar today who kept their jobs, kept their income, but for a year or 2 years, they couldn't spend their income on very many things because they couldn't go to restaurants, they couldn't travel, they couldn't do other kinds of things. Those are the two things that I basically do. So this is an unusual combination of shocks. The second thing, of course, is that there was a policy response, which was a massive fiscal policy response that was not really about getting people back to work at all. It was really about allowing people to stay away from work by providing financial support. But that had associated with it a huge increase in the Bank of Canada's balance sheet, which we'll talk a little bit more about. So a huge fiscal response and a monetary response. We had supply chain disruptions across many parts of the economy, which of course led to, it wasn't just supply disruptions, it was reductions in supply capacity because of those supply chain disruptions. But that was matched or paired, I suppose, the way I'm describing it, with a bunch of pent-up demand that happened precisely because of people like us who kept their income, but at some point it was building up into a huge amount. I seem to recall by the end of 2022 there was something like $350 billion. That's something like 14 percentage points of GDP of excess savings. And the final thing, of course, is that we had the Russian invasion of Ukraine, which for quite a while, but most of it has dissipated now, drove up energy and commodity prices. But all of this also led into inflation expectations becoming unanchored. So it was a remarkable few years. I think I'm no apologist for the Bank of Canada, but I do think we should have a little bit of sympathy for people that were in policy positions over the past few years, because it was a very tough few years. The result of this is that inflation was very complicated. It had multiple causes. It was difficult to know exactly what was happening and in what relative quantities was driving inflation. Some of those things the central bank can do something about, and some of those things the central bank really can't do anything about. So here you see, and it's unlabeled, I apologize, this is data from the Bank of Canada, but the blue line is the CPI inflation rate, and the yellow line is one of the measures of core. But what you see is that inflation clearly deviated away from the target. You see when the rate cuts begin in March of 2020, and they didn't take very long. And then, of course, the rate hikes don't begin until March of 2022. Some people, of course, argue that central banks, the Bank of Canada included, waited too long to raise rates. I'm not sure that I agree with that, but it certainly looks that way in this diagram. But given the confusion about exactly what was happening and what the sources of the inflation was, it took that while for rate hikes to begin. Now, here's the dramatic policy actions. On the left-hand side, you see the Bank of Canada's assets. So the top line is total assets. You see most of the action with an increase in the holding of Government of Canada bonds. It is worth emphasizing just how dramatic those actions are. This is a basically quintupling of the Bank of Canada's balance sheet in a period of a few months, which is huge. I mean, this is a balance sheet that during normal times will expand by 5 or 6% a year, but now it's going up by 400% in less than a year. But you also see, and I'll come back to this, you also see the decline in those assets over the past 2 years. So this is the quantitative tightening. So you see the quantitative easing at the beginning of this period, 2020 and 2021, and then the quantitative tightening as the government bond the holding of bonds by the Bank of Canada are sort of passively being undone. On the right-hand side, of course, you see the bank's target for the overnight interest rate. A lot of people describe this as an unprecedented monetary tightening. Well, and it may be an unprecedented monetary tightening, but of course that was an unprecedented monetary tightening in response to a rather unprecedented, very quick, sharp increase in inflation. So when will rate cuts begin? Given if you just back up to that and you say, well, here we are, the bank's target for the overnight rate is now at 5%. So when are rates going to start falling? That, of course, is an often talked about topic these days. I think it's important remembering that monetary policy works with a lag. And because it works with a lag, it is necessarily forward-looking. And what that means to me is that if you think about the last time the policy rate increased, which was July in 2023, it seems to me reasonable to assume that what the bank was thinking about at that time was that those rate increases, they wouldn't do anything with the intention of quickly unwinding them, because their view, the bank's view, is that rate increases impact the real economy over a period of roughly a year and inflation over a period of something like 2 years or maybe even more. So if you assume that those lags are, roughly the lags they're thinking about, then it seems to me that we should be expecting that the bank is thinking that when it raised rates in July of 2023, the last time, then it was expecting those rate increases to stay in place for something like 12 to 18 months. And it would anticipate that those rate increases would have slowed down the economy, because that's exactly why it was doing that. It was doing those rate increases to slow down aggregate demand, to reduce the extent of excess demand in the economy. And so that leads me to point number 3, which is that it seems to me that the bank is unlikely to reduce rates until, it's unlikely to reduce rates before that 12 to 18 months, which is the end of this year, unless the economy is slowing down in an excessive way. So the bank was certainly expecting the economy to slow down in response to its rate increases. That's why it did it. And it knows how long those lags are, which means it presumably is expecting, it would be expecting to reduce rates only if the economy slowed down significantly faster than it was expecting. So that leads me to ask, are there signs of excessive slowing? Not just slowing, but excessive slowing. So here is a graph from the latest Bank of Canada for the Monetary Policy Report in October. On the left-hand side, you see job vacancies clearly coming down over the past 2 years. On the right, you see the unemployment rate clearly coming down and now just starting to rise again in late of 2023. So what we see is a gently slowing economy. You've seen the GDP statistics, and I think Warren is going to be showing us some lately. The last couple of months, basically GDP has flatlined. And the bank is estimating that the output gap is pretty close to zero. The interval around that is, from negative 0.25 to positive 0.5, but that's pretty close to a zero output gap, given the uncertainty in measuring the output gap. So to me, this is a gently slowing economy, but it's not obviously an excessively slowing economy. So to me, we listen to speeches by the governor and other members of the governing council, and they say things like, well, we're going to keep the rates where they are, and until we see inflation coming down, inflation expectations coming down, wage growth subsiding. So here are inflation expectations on the left-hand side, and you see that those numbers are still fairly high. Given our inflation target at 2%, and that inflation expectations pre-pandemic were very well anchored at 2%, it seems to me that they are going to be concerned about these inflation expectations still being at 3 or 4 or 5, depending on which measures you're looking. On the right-hand side, you see wage growth. Wage growth, depending again on the measures you're looking at, are in the ballpark of 4%, maybe a little bit higher. And this is in a world where productivity growth is very low. So again, this is going to be a concern by the Bank of Canada. So to me, I look at this and I think, I'm not convinced that the Bank of Canada is getting ready to lower rates anytime soon. I think they will be ready to lower rates if the economy, or when the economy slows further, considerably further. But I do think we should expect considerably more slowing before the bank is going to consider that its rate increases have played their role fully, I suppose. Now that brings me to the final topic in my final 2 minutes, which is, where are rates going to go once they start falling? So this brings you to a discussion of the neutral interest rate. Now the neutral interest rate is the rate that holds when GDP is at potential, so the output gap is closed, when inflation is at its target, and when all the dust has settled after monetary policy actions. So to me, I think about this in terms of the market for loanable funds in a long run equilibrium. So with GDP at potential and that output gap closed, then where is the balance of the demand for investment and the supply of saving? Now, the Bank of Canada estimates in a recent working paper that the nominal neutral policy rate is between 2 and 3%. Now, they've given some speeches lately suggesting that maybe it's higher than that, okay? If we take the 2%, 2 to 3% seriously, that means that the bank's policy rate, once it starts falling, would be on track for falling by about 2 percentage points, maybe even a little bit more. And what's behind, by the way, this discussion about the falling of the neutral interest rate over the past several years? I'm trying to capture it in this diagram. So here you see the red line is the nominal yield on long government bonds, and the blue line is the real return bond, long term. So they're both the same maturity. What you see then is basically a 20-year decline in real rates. And this is the notion that has been made famous again, I suppose, by Larry Summers' secular stagnation. This is an old idea. I think it goes back to Alvin Hansen in the 1930s. But Larry Summers has made this a much more prominent idea in recent years. And there's a lot of reasons for why there has been an expectation that the real neutral rate has been declining. One of those reasons, demographics plays a role, income inequality plays a role. But one of the important parts of the story is the belief that in the current, what is sometimes called an information or a digital economy, investment is less capital intensive than it used to be. In other words, we're building more computers and mobile phones and less dams and highways and, big, heavy capital intensive stuff. And that reduces the demand or slows down the growth of demand of capital investment and helps to keep real interest rates lower. Now, you see what I've circled in the green circle there is what's happened to these bond yields in the last 2 years, and they are clearly going up. We don't know exactly what's going to happen, right, in the next 2 or 3 years. But I do wonder, and I want to come back to this, the comments that have been raised by the governor and the deputy governors in the last few speeches about whether the neutral rate may be rising. Because I think there are reasons why maybe the neutral rate is going to be a little higher than we have been thinking over the past few years. My first 2 points is that I think we are going to see some widespread, and I don't just mean across Canada, but across many countries, replacement of old infrastructure. Now, my view on this may be biased because I live in Montreal where infrastructure falls down by the ton. And so I see on a daily basis a need for infrastructure to be replaced. But I think it's probably true, maybe not as true as it is in Montreal elsewhere, but I think it is true across Canada and probably across the United States that there's a lot of infrastructure that was built in the 50s and 60s and 70s that is going to need replacement. And that is heavy capital intensive stuff. The second point is about energy transition. And I think this is a point that applies around the world, certainly in all the advanced economies, that I think most countries are now gearing up for a massive investment exercise that will mostly be done, I think, by the private sector. But it's effectively about replacing high emitting energy infrastructure with low emitting energy infrastructure. So you think about swapping out coal burning electricity plants with wind farms or solar farms or things like that. Both points 1 and 2 are not necessarily going to change the path of potential output growth in the economy, but they will change the nature of that growth. Okay. If you replace a worn out bridge with a new bridge, it doesn't necessarily change the path of potential output. And if you replace coal-fired electricity with wind power, it doesn't necessarily change the path of potential output growth. But it does, both of those things represent a big increase in investment. So both of those things, to me, are probably going to be pushing up investment demand over time. And the third point is about government debt and ongoing budget deficits. We have returned to a world of high government debt. not as high as it has always been or has been at its highest, but it is certainly high. And it appears that governments are becoming more comfortable with budget deficits. Some of that may be because of defense spending that has, I think, its importance we've been reminded about lately. But if we do continue with budget deficits, then we're talking about a decrease in the supply of national saving. So all three of these things are working in the direction, I think, of maybe pushing up that neutral rate. So I'm going to end there. I am not the kind of person that will give you or is able to give you a forecast for the future. I try to avoid that, and I think you should be glad that I avoid that. But I do wonder. I want to be a bit skeptical about making the case for imminent rate cuts. I think there's good reason to think it's not going to happen in the very short run, and some skepticism, or at least some curiosity, about where that target ultimately is when the bank starts lowering rates, because it may not be as low as we have been thinking over the past few years. And I'll stop right there.
Okay, maybe I'll jump in here if I could. I'm mindful of where we are on the clock here, Jason. So what I'm going to do is aim to get through a little bit of material quite quickly. I'm going to show you some images, but I'm going to move through them pretty fast. So I'll really just try to emphasize the core message. If we go to my first slide here, I think if we're trying to have a discussion about where the Bank of Canada is headed in the year or years ahead, it's important to understand where we're at and where we've come from. And without putting too fine a point on it, I would say from our perspective, while we haven't met Chris's test for excessive slowdown, we do see and argue that the Canadian economy is not faring terribly well currently, particularly once you control for, strip out this enormous amount of, I guess what we might call demographic inflation, this population surge that most webinar participants now fully understand, a kind of a unique Canadian aspect here. And from an individual household perspective, the Canadian economy is contracting. It really has been since the Bank of Canada got going on interest rate hikes in 2022. If we go to my next slide, please. I think the other point I'd want to emphasize is that this lack of traction, economic malaise, whatever you want to call it, is likely to extend fully into 2024. In fact, it might even deepen. And again, whether this meets Chris's test for excessive slowdown or not is debatable. What I'm showing you here is the consensus range of forecasts for growth in Canada in 2024. And I don't mind telling you, and as you can see here, that red bar is National Bank. We are at the more pessimistic end of the spectrum, particularly relative to the other large Canadian banks. So again, excessive, I guess, is debatable, but a material slowing and really a continued absence of growth, not just in per capita terms, but now in outright terms. And from our perspective, we really don't see many of the traditional building blocks of growth, expenditure-based GDP accounting, for example, that are tipping into positive territory, save for perhaps some residual fiscal stimulus, which, as Chris alluded to, is maybe warrants its whole separate discussion. I'll turn to my next slide, please. I guess the good news, to some extent, if you buy our forecast for economic growth, that a more pronounced slowdown relative to consensus, that absence of growth means more slack in the economy. So it does give us confidence that the initial progress that we've secured on inflation will be continued. I want to be mindful of the fact that inflation is not at 2%. We're in and around 3% currently, nor am I expecting in the next CPI release that we're going to make further inroads towards 2%. I think we're dealing with in the very short term some base effects that might complicate the picture, but we see 2% inflation as likely attainable by around summertime. Now, core inflation, and I'll put air quotes around core inflation, is another story. Again, I think we should expect that core inflation takes a little bit longer to get back to target. We have seen some important momentum or progress on it momentum. We tend to look at the 3-month annualized rate of change here. And again, we're not all the way back to 2%. The average median and trim reading on a 3-month annualized basis is 2.4, inside the target band, but not all the way home. But again, some important progress being secured and consistent with our more pessimistic outlook for growth, more slack. And as a result, a more achievable path all the way back to 2% inflation. Now, I use those air quotes. If we could go to my next slide, air quotes on core inflation. And that's because, you know, really from our perspective, the Bank of Canada's communications and signaling on what are really the vital measures of underlying inflation that we should be focused on are hardly static. They've been moving around a lot. This is an illustration from a very important special report that my colleagues penned last year on the bank's thinking and utilization of core inflation measures. And I'm not doing the retrospective on the last 30 plus years of inflation targeting, just the last 3 years. We've seen the Bank of Canada emphasize and then de-emphasize various measures. Some of these are hard to replicate. Some of them are less easy to understand for a layperson. So for a Bank of Canada focused on transparency, who's presumably, they tell us, interested in making sure their message and approach is understood, this sort of less than static, stable approach to targeting and highlighting underlying inflation pressures is somewhat problematic. From our perspective, it's time for an in-depth reassessment of core inflation in Canada. And it's a bit of a soapbox issue that I don't have time to get into in great detail, but perhaps it might be appropriate to think about going all the way back to an exclusionary-based measure of core inflation. I'll get off the soapbox, go to my next slide, and talk about a couple of near-term risk factors. Chris touched on a few of them. Inflation expectations is an important one that Chris spoke to. And again, I want to concede that we're not there yet, obviously. Another, I guess we might call structural impediment on the road back to price stability is shelter costs. And this is what happens when you have that enormous demographic inflation that I spoke about, that extraordinary population growth creates housing demand, which intersects with limited supply and leaves rents, at lofty levels. And I think that's going to be a hard fix in the short term. I want to concede that. The other complicating factor in the here and now, and one that we were reminded of just Friday, is that wages, again, remain problematic, and wage growth is not consistent with price stability. The Bank of Canada has talked about 4 to 5% inflation. Well, if you looked at Friday's labor force survey, it was even above 5%. So again, you want to be careful about expecting that imminent, very near-term pivot to lower interest rates in an environment of 5% plus wage growth. We do, however, see a pathway to more becalmed wages. And again, it's the other side of this demographic story. The working age population is expanding and expanding rapidly. And it's outstripping by a material factor the growth in employment. And what that means is the unemployment rate is moving up and will continue to move up. We think the unemployment rate will be taking aim at around 7% by the end of this year, above NAIRU, and consistent in our view with much less forceful wage growth. On my next slide, please. And I realize I'm moving through this quickly, but I do want to just give you our own expectations that I will offer with humility for the Bank of Canada. So again, Chris talked about, the Bank of Canada maybe wanting to keep those policy rates in place for 12 to 18 months. I guess when we start the clock on that is perhaps debatable. I might be inclined to start the clock on more like at the start of last year. I think what we're going to see from the Bank of Canada is accumulating evidence that gives them comfort with the idea that policy need not be as restrictive. So I don't want to suggest that we need to be getting policy rates into stimulative territory, but less restrictive territory, consistent again with a sub-consensus, off-consensus view for growth and inflation. The market has very much bought the pivot narrative. The policy pivot is manifest in trading expectations. If you look at OAS markets, we've got something like 110 to 115 basis points of easing priced in calendar 2024 for the Bank of Canada, even more from the Fed. I think when the Bank of Canada does get going, when they see compelling, sufficient evidence that policy need no longer be restrictive, we should be expecting them to move and move fairly quickly in our view. Now, I said I offer that with humility. I will just very quickly remind you of how badly we've been getting this. On my next slide, please, you'll see that the policy pivot that many talked about, and I think we discussed on this webinar last year, never materialized in 2023. So the implied path and the actual path can and has diverged quite materially. And let's not even try to remember what happened in 2022 and the amount of tightening that was ultimately deemed necessary was many multiples of what economists and markets thought possible at the start of the year. The other caution on my next slide, if I could, is that economists love to do empirical analysis, and we can technically find a sample of easing cycles in Canada. There's 7, in fact, in the era in which the target rate has been the policy tool. 7's not a terribly large sample, nor is it clear that there's a really representative cycle that we could lean into and place blind faith in. I'm not even sure I buy the idea of charting out some type of average path here. I guess what we can say is that starting at 5% as opposed to sub 2% gives us some latitude to move and perhaps again move quickly once conditions are in place. The terminal rate, as Chris indicated, is all going to come down to a discussion about where R star is. That's something we'll probably get into in the Q&A. The other caveat I want to offer, and this is my last 2 slides here on the next slide, please, is that not all else is equal, certainly not as it relates to the balance sheet. Chris showed you this already, but I think what I'd like to emphasize here on the liability side, Chris showed you assets, is that settlement balances, or this idea of excess liquidity, is working its way down towards what I guess we might call the steady state, which is hard to pin down with a high degree of precision. I would say that even though 2024 won't be the peak year for balance sheet runoff, you should expect that QT is more binding in terms of draining liquidity and maybe unsettling or tightening financial conditions as the year progresses. So don't be fooled by the relative ease with which we have absorbed the first couple rounds of QT. I think this becomes a much more material feature of the discussion on monetary policy in 2024. It already is in the US. If we go to my final slide, please. You would have seen with the Fed's decision in December, even more recently, and I'm talking about in the last couple of days here, Fed speakers more openly discussing the need to perhaps adjust the Fed's quantitative tightening and balance sheet runoff as liquidity is drained from the US financial system. We tend to look to reserve balances, of course, overnight reverse repo balances and settlement balances, which have rapidly declined. Now, not all of that is QT related, but again, I think it speaks to the fact that the balance sheet part of the policy agenda for monetary policymakers is going to become very topical, perhaps quicker than some anticipate. The Fed is committed to having a discussion about those technical aspects of the balance sheet adjustment before presumably making changes. And again, for a Bank of Canada interested in communicating and being transparent, this is maybe a recommendation they could take on board as well. Let's have that open discussion around the technical aspects of what the new steady state in the Government of Canada securities market and the new steady state for the Bank of Canada's balance sheet will really look like. That's my time. I'm going to turn it back to Jason for what I'm sure will be a lively Q&A. Thank you.
Thanks very much, Warren and Chris. We'll now turn to the Q&A. And as a reminder, if anyone in the audience has a question, we invite you to type it into the chat box on the bottom right of the screen to all panelists. I'll kick off the Q&A. Inflation surge in 2021 through mid-22 surprised many observers, just as its rapid decline last year was faster than many anticipated. Both of you have provided an in-depth perspective on inflation's path over the past 3 years. What lessons do you draw for the conduct of monetary policy in the jump and subsequent fall in inflation over the past 3 years?
Can I jump in real quick, Chris, and then I'll hand it to you?
Please.
Yeah, okay. So look, I use that word humility. It's a word that the governor himself used in his end of year address. And I think it's a word to probably keep in top of mind. You know, Chris highlighted the unusual, remarkable environment we've been operating in. And I think what, you know, the failure to really understand where inflation is going to go and the surprises that we've been consistently taking on board when it comes to inflation just tells you, reminds us that we're still figuring things out in this new environment. We're not in a steady state. We're in another year of transition. It seems like we've been transitioning one way or the other now for a few years.
Yeah.
And I think transition will be the name of the game again in 2024. Certainly from our perspective, the real economy continues to transition, continues to show that sort of sag and slumping under the weight of restrictive monetary policy. From an inflation perspective, I guess it does give us some confidence that we are getting back to balance and maybe even in an excess slack or output gap environment that will finally allow us to get all the way home, but we're not there yet. And I think to Chris's point, it maybe argues against an immediate near-term pivot to lower interest rates, but those conditions are gradually getting in place from my perspective.
Yeah, I agree with what Warren just said. I think humility is good. I think also explaining complexity is good. I've always been a fan of central banks that that were okay to admit that the world is very complex and we don't necessarily know exactly what's going on. And if there was any time that was complex, it was the last 3 or 4 years. So one lesson that comes out of all of this is, well, next time we get hit with a pandemic that's followed by a war, we'll maybe know what to expect. But let's hope that doesn't happen. But more generally, I think the central bank should be, not just the Bank of Canada, but all central banks should be prepared to explain the complexity. I mean, we had gotten to a point where many people thought that all inflation all the time was perfectly controllable by central banks. Well, that was never true, and it certainly hasn't been true in the last 4 years. There's some sources of inflation that the central bank can do very little about. And I think explaining that sort of the complexity, but also the limitations of the central bank, I think is something we can always improve on. The other thing I want to come back to Warren's great slide on the many measures of core inflation. You know, there is a sense that the bank has been bouncing around and saying, okay, well, no, this measure isn't very good. Man, let's take a look at this measure. And there is a problem in that. There's a communications problem. There is a sense that, you know, they don't know, but they're sort of flailing. And so I think re-examining what we mean by core and trying to come up with the not perfect measure, because there will be no such thing, but to come up with a measure that's pretty good most of the time and stick with it, I think would be really great.
Thanks, both of you. Next question. Warren, you talked extensively about this, but the Bank of Canada's quantitative easing, or QE, was its first ever. Unlike the Fed and European Central Bank that hugely increased, there are already enormous QE programs in 2020 and 2021. The subsequent quantitative tightening, or QT, has been a crucial complement to the bank's rate hikes, with monetary policy restraint from mid-22 onward. Stepping back now, looking at the last 3 years, how do you see the benefits and costs of the BOC's use of quantitative easing and its move to quantitative tightening?
Okay, let me jump in again first, if I could. It's not that I want to take all these questions first crack. I just know Chris is going to make so many good points that I got my marker down first. But look, I think the first thing we probably want to concede is that it is hard to quantify, again, with precision, the benefits of QE. And we weren't just doing QE, by the way, we were doing credit easing as well. If you think about the provincial money market purchase program, provincial bond purchase program, corporate bond purchase program, CMBs, and so on. So look, we used a lot of unconventional tools on the balance sheet side. I think qualitatively, the benefits are pretty easy. I mean, like one, you create demand for securities, you drive up the price, you lower the yield, you tighten the spread. So when you're trying to provide as much support for an economy as possible, QE is, and credit easing for that matter, is a very powerful tool. I think the opposite also holds, right? We're now in an environment of balance sheet runoff, and that is by design draining liquidity and tightening financial conditions relative to where they would be otherwise. And again, hard to quantify just how much of an impact that's going to have on longer term interest rates and or credit spreads. I think what we can expect is that as that excess liquidity drains from the system, and it drains slower than it was injected, obviously, we get to tighter and tighter financial conditions, which might make it more difficult for risk assets to maintain the surprising traction that they have had. I guess the cost that you worry about is, we've not used these tools a lot. So in some cases, they're not that well understood. In some cases, there's been arguments of, is the central bank just monetizing government debt? You want to avoid the appearance of lack of independence and so on. I think, more and more the balance sheet is understood by many investors. But again, I think you want to be really careful about the optics of what you're doing with the balance sheet. The signaling, finally, I think is a vital consideration. It's not just the fact that you're in there buying or running off bonds. It's the signal to market participants and to markets themselves that really becomes vital. Chris, I don't know what you want to add to that.
I think Warren is absolutely right that it's hard to be precise about both the costs and the benefits. I want to talk about liquidity and impact on long-term interest rates. And I think it's really important to draw a distinction between the QE that we saw during the global financial crisis, which didn't take place in Canada, but took place in other countries, and the QE that we saw during COVID. Because I think the shocks were fundamentally different. And I think actually the case for QE was fundamentally different. So with a major collapse in aggregate demand associated with the global financial crisis, with banks collapsing or on the edge of collapsing, and a credit crisis and liquidity problems, I think QE, there was a much stronger case for QE in the global financial crisis than there was in COVID. If you listen to the governor of the bank talk today about QE, or over the past few years talk about QE, Tiff will say mostly that it was about keeping interest rates down. It was also, of course, about providing liquidity to the banking system, because that's what happens. But I actually would argue, and I argued this last year, Jason, and I'm going to beat the drum again. I think, and maybe we'll only really know this for sure with the passage of time, but I actually think the case for QE was weaker during COVID than it was during the global financial crisis. I think if interest rates had gone up by 100 basis points or 150 basis points because of government borrowing, starting from a very, very low level, that wouldn't have been the end of the world. I think we weren't in a situation where we needed massive liquidity injections into a financial system that was on its edge. And I would draw the distinction, by the way, between the first few months of COVID, where I think this was reasonable, and the following year and a half after that, where I think you could argue against QE. So, but I think the truth is we're not going to know about the detailed costs of doing QE for a while. But just my sense of how QE works and what it does is that there was a weaker case for it. But I'll end by saying this. Given that other major central banks were doing QE, it would have been impossible for the Bank of Canada not to do QE. Okay. But I do think I would love to have kind of been in that discussion among the central banks in March of 2020 and heard the discussion about QE, because I actually think it's a weaker case for doing it.
Thanks to both of you. I'm now going to turn to more of the questions from the attendees and make an apology up front. There's a lot of very good ones, and we simply won't have time to get through them. So to reiterate my apologies in that regard. First question, will there be a rate cut by the Bank of Canada if core inflation still remains high throughout 2024?
I'll start. So I guess the honest answer is, I guess we'll wait and see. But look, I think the bank still believes that its job is to keep inflation down, and it does that through sort of as an intermediate target, looking at the performance of the real economy, unemployment rate, output gap, etc. So put it this way, if the economy is more or less a potential output and core inflation is significantly above target, then I would expect the bank to maybe lower rates a little bit, but certainly not very much. I would expect them to retain a tight monetary policy, unless core inflation is above its target for reasons that have nothing to do with excess demand. Okay. But if core inflation is just very slow in getting back down, I think the bank's logic would be, well, then we've got to, wring that inflation out of the system, out of the wage growth, out of the expectations, and you do that by maintaining a tight monetary policy, a tight monetary stance. So that's what I would expect.
Yeah, I'd agree with Chris on all those points. I think what I would just want to emphasize is that from our perspective, that's the scenario, the question is predicated on a scenario that we don't see playing out. So nonetheless, I think we need to acknowledge that if the economy continues to show surprising resilience, and as a result, core inflation for cyclical and factors related to the economy, as Chris outlined, remains higher than what is expected, higher than what is deemed acceptable or tolerable, then it's going to be pretty difficult to be making a case that policy needs to be less restrictive. I think from our perspective, we're already seeing some important progress, momentum, and a pathway towards less restrictive policy, not at the upcoming meeting, not at the meeting after that, perhaps, but perhaps sometime in the spring, in the second quarter, I think would be from our perspective, at the earliest time frame, you'd be thinking about that. But it requires core inflation to continue to behave and to cooperate.
Next question, your views on the housing market and how it behaves and its impact on interest rates in 2024.
Can I start, Warren?
Please.
Yes, I have views on the housing market. So I think the housing market is a great example of something we should have a webinar just on the housing situation. But I think this is something that is complicating monetary policy. It is not the primary focus of monetary policy, and in my view, it should not be. But it is absolutely complicating monetary policy because the bank knows that the bank knows what's going on in the housing market. They know how many people are tapped out on very large mortgages. They know as they raise interest rates to tighten monetary policy, it has pushed up mortgage rates. It's made things tighter for people either that have recent mortgages or have to renew their mortgages, or that are simply in the market for a housing. So it has made that more difficult for all of those people. But of course, that's also part of how monetary policy works. When it tightens, it dries up those rates, and it means that if people are now forced to pay more on their mortgage, they're going to spend less on something else. So it is making it, I think, more difficult, painful, if you like, for some people when the bank tightens. But I also believe that the bank fundamentally is going to look more at core inflation and more at the output gap and unemployment rate and employment growth and those things than what's going on in the housing market.
Yeah, I think there's a bunch of dimensions to housing. Chris has touched on some. I think, the other thing we want to probably acknowledge here is that if you think about the policy path that we traced out last year, we had this hike delivered in January and this sort of notional pause idea, only to have the bank restart its tightening in June and July as the housing market reaccelerated on the relief in interest rates. So I think, there's this sort of back and forth between, where interest rates are trading and how the housing market is performing. I am mindful of the roughly 100 basis points or more of a decline in 5-year Canada yields in the fourth quarter of last year, and the potential to kickstart another round of housing market activity. So I think we want to be really mindful of the fact that the housing market is quite dynamic and reacts quite meaningfully to these changes in underlying mortgage rates. I think broadly speaking, and taking a step back, we need to be prepared for monetary policy to do its job. And by that, I mean, look, we've got a highly leveraged housing dependent economy. If you really want to slow the economy down in the hopes of securing price stability, then housing is one of those sectors, as Chris points out, that you got to look to as taking some lumps. And that's really what we've been going through. And I don't think we're done that adjustment process. The bank's done a lot of work, and every Canadian economist has done a lot of work in terms of the vintages of mortgages that are going to refi, that have refied already, what's in front of us. Even with that interest rate relief that I touched on in the final quarter of last year, we know that the refi process is going to be painful. And this is, I guess, one of those areas where monetary policy works. Well, it works quickly, but also with a lag, both. It works quickly in terms of changing sentiment and confidence in housing markets, but it works with a bit of a lag in terms of getting Canadians into those renewed refied mortgages at higher rates that will probably require some significant rationing on the part of consumers. And again, gets us to that slower growth environment that we see in 2024. That's probably a precondition necessary to get all the way back home on inflation.
Next question. How do you incorporate the level of fiscal deficits into your assessment of Bank of Canada policy? In particular, this attendee is asking, given the unprecedented high level of deficits at such low levels of unemployment, is monetary policy that restrictive when you look over the past 3 to 4 decades of the fiscal policy setting?
I think it's really important to emphasize which region, jurisdiction you're focused on here. Because there's a broader discussion we could have about fiscal policy, working at cross purposes with monetary policy in the current environment. And there's some pretty clear examples, nations very close to us, where unsustainable fiscal policies, are pretty easy to spot. This is not to be an apologist for any Canadian politicians or governments here, but I would say that from my perspective, we run much less perilous fiscal policy in Canada. Is it perfect? Of course not. Is there perhaps politically motivated spending that is maybe at the margin complicating life here and there for the central bank? Sure. Is there a tendency on the part of governments to want to react to an affordability crisis? Absolutely. And is the policy mix perfectly aligned, fiscal and monetary? It's rarely is it. But I think, compared to what we're seeing in the United States, compared to, in fact, what you see in most European nations, we have, in my opinion, a more sustainable, less perilous path forward on fiscal policy. It probably would be nice to have gotten to balance when we were, in excess demand at the federal level. We didn't quite get there, but I'm not sure it's as complicated here as it is in some other jurisdictions. And you really only have to look at the growth in debt in Canada versus pretty much any other major advanced economy peer.
I like the way Warren's expression of it's a less perilous path. I like that. And I think that's probably true both economically and politically. Look, I agree with everything that Warren just said. Let me just add that at least at the federal level, and I don't want to be an apologist for the current government's fiscal policy, but at the federal level, deficits are something like 1.5 or 1.4% of GDP. That's not huge. I mean, it's still $35 billion or whatever that number is, but it's not huge. And, it was not so long ago in my life, at least in the mid 1980s, when the federal budget deficit was something like 8% of GDP, 8%. So I'm less worried about the deficits, although I'd be very happy to quibble about particular spending projects. But from the bank's point of view, I think I think the bank is obviously taking it into account. I think it's probably the case that the bank's policy would be less tight if fiscal policy was tighter. I think that's just the way it works. But I just don't think the current deficit situation is so large as to be a problem either on the fiscal side or for monetary policy.
Thanks, both of you. With apologies to everyone, again, there's a host of good questions that we don't have enough time for. It's our last question. Looking at last year, higher for longer policy rates have meant rising inflation adjusted or real yields, as both of you have commented on. But I want to focus on the fact of how far above the ultra low levels that prevailed through the 2010s, right up through the first half in 2022, by comparison to where we are today. Stepping back, and Chris, you mentioned this, and looking forward to Warren's perspective as well, where do you see the appropriate range for real policy yields if inflation continues to subside into the 2 to 3% area this year? And what should policy aim for over the medium term as a sustainable real rate to support durable economic growth and low inflation?
Ooh, that's a whole separate webinar there, Jason. I guess that's a good and meaty question to end on. Let me, Chris, I think nicely outlined some of the thinking that goes into assessing and sort of, this is like finger in the air type stuff, trying to assess where R star is. And again, I think I'll commend the Bank of Canada. Deputy Governor Beaudry had quite a good speech on this in June, if I recall correctly, where we really talked about the factors that had led to perhaps depressing neutral rates of interest and why some of those may be flipping the other way. I liked the way Chris outlined what's happening in terms of the needed capital investment on energy transition and maybe infrastructure rebuild and so on. It seems like whether it's on demographics, on geopolitics and globalization, and on investment, that there's maybe a few factors now tipping towards a higher neutral rate of interest. Again, it's very hard to pin this down with any degree of accuracy. The other thing I would say is that R star isn't steady necessarily over time. Where the neutral rate of interest in 2024 is, it might be quite a bit different in 2025, 2026 going forward, because these flows between investment and saving, really can change quite dramatically over the piece. So I think, to sum it up from our perspective, look, we're at 5% on a nominal overnight rate. If you thought that a nominal R star is something like 2 to 3%, then I'd probably take the high end of the range. We're clearly restrictive. The economy is showing signs of that restrictiveness. And do we need an immediate, and can we justify an immediate pivot to lower interest rates? Probably not, but maybe not that far off. And let's at least get to perhaps neutral if the economy and inflation behave the way we expect. So I guess what that means is let's shoot for 3%, 200 basis points of easing, let's say, over the coming 15 to 18 months to get us into a less restrictive territory that the economy can better operate in.
Yeah, I agree with everything Warren just said. Let me just make an observation about the way the neutral rate is estimated. So I was just rereading this Bank of Canada working paper that was, I think, from 6 months ago, that was doing this, that used 4 different approaches, and it kind of came back to this estimated range of 2% to 3% for the nominal policy neutral rate. And one of the methods is basically looking at a neoclassical growth model, and what you have to feed into that is what's the growth rate of potential, not the level of potential, the growth rate of potential. And but these models are, not surprisingly, they're missing the sorts of things I was talking about, like capital investment for energy transition and capital investment for infrastructure renewal. And this is why I said what I said on my last slide, which is I can imagine a world where the growth rate of potential output is 2%, okay? And it's not changed by what I'm about to say. but we still have to do a whole pile of investment. So in your typical story about the market for loanable funds, you say, oh, well, if we actually are going to have an increase in investment demand, that's going to drive up the neutral rate, but it's also going to lead to higher investment in equilibrium, and that's going to be a higher growth path for potential output. Well, that's true if it's new investment, but it's not necessarily true if it's replacement investment. So if we are going to basically wipe out a bunch of high emitting capital stock and replace it with low emitting capital stock, it may have no impact on the growth rate of potential output, but it still may drive up the real rate. Okay. And same thing if you're replacing an old bridge with a new bridge. So that just didn't occur to me actually until I had read that paper, and I thought, okay, does there have to be a one-to-one tie between the growth rate of potential and the neutral rate? And I think the answer is no. So I would just encourage people to think about what's really going into the estimation of the neutral rate, because I think the next few years we'll see a fair amount of discussion about this point, not just from a monetary policy point of view, but how much investment are we going to be doing for energy transition and other things like that. But I think they're going to be a large amount of investment.
Well, thank you very much, Chris and Warren and Jason, for sharing your insights and for leading this discussion today and helping us kick off the new year with a better idea what to expect or to start anticipating in the Bank of Canada rates. For those participants who may have joined in late, I would remind you that this event is recorded, so if you missed anything, you can actually rewatch it on the GRI website probably within a week. And of course, this was the first in a series of 4 macroeconomic policy events. Hopefully you can join us on Tuesday, January 16th at 11 to 12 noon to hear Robert Kavik, who will be speaking about the housing market outlook for 2024 with a focus on near-term trends and structural factors and examining demand, supply, and volatility. So there will be many programs developed in the first half of this year. We're about to post them on the website. Thank you all for joining us today. Reminder that there is a quick survey at the end of the session. Please take a few minutes to complete it. And we hope that you all have a great rest of your day. Thanks very much for joining us today.